como sabéis, vamos a hacerlo en inglés. We are going to switch to English because Jean-Baptiste is French, but he speak English in the presentation. We are going to present, this is the Natural Gas Report 2018. I think this is the third time in a row we are presenting this report. And this is this market report until 2023. I think this is the forecast for the future on natural gas market in the between 2010 and 2022. I think, as you know, this is normal for us to present all the reports from the International Energy here. For Jean-Baptiste is the first time. Last year it was presented by Rodrigo Pinto, as maybe you know him very well. He has gone back to the Netherlands and the minister, and he's now there. And Jean-Baptiste were coming into the International Energy Agency 1 year ago. Well, this is a report you are going to see, very interesting for the future in the US production, in the consumers, in all the markets in LNG, and after the presentation we can make some questions to Jean-Baptiste. Jean-Baptiste is French. He has over 15 years of experience. He is the senior analyst, natural gas analyst in the International Energy Agency. He joined the AA last year, I think, he has been working before in another different parts. He's graduated in economic and finance with a master in economics in France. He worked for BNP Paribas, for Gas de France and ENGIE, and well, he's a professor, a teacher, and he is very well known. But I give him the floor, and after this we will make this Q&A section in the gas report. Okay, Jean-Baptiste, the floor is yours.
Muchas gracias.
Let me check your.
Yeah.
This is, you can use this.
Thank you.
This. Okay.
Yes, thank you. Muchas gracias, Arcadio. Señores y señoras, buenos días a todos. Antes de empezar, quisiera agradecer al Club Español de Energía y a Arcadio Gutiérrez por su invitación y esta oportunidad de presentar nuestro trabajo en la producción de mercado de natural gas. Pero I've shown you all I can do with my remains of Spanish, so please bear with me because the remains of the presentation will be in English. So it's a great pleasure to be with you today and to share the outcomes of this natural gas outlook that we have launched last week with our executive director, Dr. Dubreil, during the World Gas Conference in Washington, D.C. So this is one of the first conferences that we're doing in Europe. It's a real pleasure to be here in Madrid to introduce you to this report. Before I'm starting, I would like, as an introduction and as a potential disclaimer to this outlook, I have something to confess. I've been working, as Arcadio said, in very kind introduction, been working for the industry as an analyst for over 15 years, but I must say that beyond my area of expertise in the field of energy, I'm a very lame forecaster. I've had this very bad experience over the weekend of texting to a friend who's in this room today on Saturday evening and giving the prediction that the game of yesterday would be a mere gameplay for Spain to win over Russia, which did not turn to happen as I forecasted. So I hope that by the end of this presentation you will have more confidence in the quality of the outlook that we're doing at the agency rather than my poor abilities as a football forecaster. Thank you for your patience for that. So Sorry. Oh, it was already open. Sorry. Thanks a lot. Great. Great. So, to begin with, a few words to set the scene. So, natural gas has experienced some growing and relentless growth over the past years, thanks to its ability to meet the different needs of customers all around the world. It's also a good fit in terms of environmental friendliness compared to other fuels. As you all know, natural gas is a fossil fuel, which is for some of us original sin, but even though it emits almost no sulfur dioxide, nitrogen oxides, and a lower level of carbon emission than other fossil fuels. So it has a very good position to develop itself either in mature markets such as Europe, North America, and some Asian countries, but also in emerging markets. Going forward, in this outlook, the future that we see for natural gas for the next 5 years will be shaped by three major factors. The first one is China. China is becoming the leading source of growth for natural gas in the next years. That's not only, of course, dealing with natural gas, that's a global sort of finding we have for all sources of energy, but it's particularly visible in natural gas, as we have seen last year, with both strong economic growth and market growth, pushing for more energy needs, but also with a strong policy backing from the Chinese government to win the battle over air pollution in big urban areas, with strong shift away from coal for small industrial and residential boilers to gas, to get that clean air policy, a blue sky policy as it's called in the Chinese vernacular, to get that blue sky policy going in major urban areas. Second main driver is the role of the United States. The United States is already the biggest producer of natural gas in the world, is expected to further expand in the next years thanks to the strong and cheap base of domestic production from shale gas. And this expansion will serve not only domestic markets, regional markets through exports to Mexico and to Canada, but also global markets with the expansion of liquefied natural gas. Third component, a bit more technical, but also very important, the patterns of consumption for natural gas. Historically, we've seen that power generation was the main source of natural gas demand growth. This is not the case anymore. See that competition is increasing for different sources of fuel and power generation, and industry is picking up as the main source of growth in the next years for natural gas demand, either for energy purposes and in different processes, and non-energy purposes as a feedstock for petrochemicals and fertilizers. So all in all, the picture that you will see this morning is quite positive. We see a bright future for natural gas for the next few years, and going further, if you look at the longer term outlook provided by the World Energy Outlook, it's also very positive for natural gas. This being said, it's not all pink or all blue, if you like, for natural gas. There are some major challenges ahead to make this future happen. Just to give out two of them, the first one deals with economics, prices. Those new markets that need to be tackled by natural gas are emerging markets. This means that in Asia, in Africa, in Latin America, natural gas has to be competitive. to become the fuel of choice and to make sure that it retains its foothold on those new markets. It deals not only with the capacity of suppliers to provide competitive prices, but also to local governments to transform their monopolistic structure to increase competition and thrive new demand. The second aspect is technical. It goes back to the first point I was mentioning about the environmental friendliness of natural gas. So, alright, there's less CO2, SOx and NOx than in contents of other fossil fuels. Yet, methane, which is the primary component of natural gas, is a potent greenhouse gas. And it owes to the whole industry to carry on and keep on improving all along the value chain to make sure that the gas leaks will resume and that the environmental image of natural gas will not be damaged by concerns over methane emissions. So, as I said in the introduction, natural gas has experienced sustained growth over the past. Last year was particularly important for natural gas. As you can see on that figure, the overall demand almost doubled compared to the average we experienced over the past years. First, very important message. Last year we experienced 3% growth globally for natural gas, a figure we've not seen ever since 2010. So that was, for some analysts, the golden year of natural gas. The question is, this is one of the points we're tackling in the report, is it a single year or is it the beginning of a new era for natural gas? Second, very interesting takeaway, the contributions of the different sectors to that growth. Traditionally, as I said earlier, power generation, which is at the bottom, the dark purple, accounts for the bulk of additional consumption. Last year we see that industry and buildings accounted for over 80% of that growth. Again, most of that growth came from China, where in China, as you know, coal is the main source for power generation. In this report, and I'll go through it a bit later on, we anticipate that natural gas has some future in power generation, but we don't see coal being displaced by natural gas, at least in the near future. So if we look a bit forward in terms of evolution of consumption in the next few years, the picture is globally quite positive. We anticipate an overall 1.6, 1.7 additional growth per year over the next 5 years. So to answer the previous question, the 3-point growth that we've seen last year is not the new norm. It was a one-off, mainly owing to that major switch from coal to gas in China. We do anticipate that China will remain to be the main engine of growth, but to have this growth ongoing, still have to have a lot of positive factors to make it happen, both in terms of economics and in terms of policy-driven messages. So if we look a bit further in terms of contribution, well, first, who does not contribute to that growth? You see at the bottom of the chart, there's some decrease in consumption, mainly in Russia, Japan, and Europe. Well, in all those three cases, it links to the same story, power generation. In Europe, we anticipate that renewables will continue to grow in terms of power generation, whereas the overall demand for power is stagnating. So gas will keep on struggling against renewables to find its way on the markets, even though some support will be provided in the next years with the phase out of nuclear in Germany. In Japan, power generation again, with the progressive restart of nuclear capacity, which will lead to less demand less demand in natural gas for power generation. And in Russia, it's the replacement of inefficient gas turbines by more efficient power plants to lead to a decrease in consumption. So those are the less positive messages, I would say, for natural gas. But if we look at the other part of the chart, we see quite substantial growth in other parts of the world. In Latin America, mainly driven by Argentina, to a lesser extent by Brazil, which is still a very small market driven by power generation and subject to the uncertainties of weather. In Africa, Africa is a very promising market for the long term. In the medium term, the main source of growth that we anticipate is the comeback of gas in Egypt. As you may know, Egypt is regaining its gas independence with the development of its gas production, and we anticipate that this further development of production will drive additional demand in the country. India is also a major contributor to growth, but the big regions that you can see on the map are the Middle East and the United States, which are both advantaged by strong and affordable gas resources, which will drive further consumption even in very mature markets such as the United States, driving both industry and power generation needs. But the main consumption contribution will come from China. China alone is expected to account for almost 40% of the total increase. This will occur in all the sectors of the economy, but mainly be driven by industry for both energy and non-energy appliances, with the strong growth of the petrochemical sector. Residential and commercial, there's a strong drive to develop the gasification of the residential sector in China, with more than 130 million new households to be connected in the next 5 years. That's the equivalent of whole of European market in the next 5 years. Plus some contribution in transportation sector, especially from buses and trucks, and power generation to the extent, as I mentioned earlier, that coal will still remain the main source of power generation. Another main driver of change, as I mentioned earlier, is how this gas is consumed. Not only who consumes it in terms of countries or region, but how, which sector does account for that growth. As you can see on this pie chart on the left, historically power generation was roughly half of the increase in consumption in natural gas. This picture is changing with the emergence of renewable, with some comeback of nuclear in some regions such as Japan or Korea, and with some comeback of coal in more developing markets. In the same time, industry is picking up as a main source of natural gas consumption in both uses as a fuel for industrial processes, for its energy contents, but also as a feedstock for different applications, for plastics, for different sort of petrochemicals, and for fertilizers. So this is for demand. The question is, who's going to supply that? Well, this is where the US emerges. We anticipate that the United States, which already experienced a very significant growth in domestic natural gas production over the past decade, is going to carry on in the same way for the next 5 years. The main driver for that production growth is a bit different though. In the past, it used to be what we call dry shale gas, so mainly gas without associated oil production. Today the trend is reverted. The main source is coming from oil shale with associated gas, coming from the south, from the Permian Basin in the Texas region. It's driven by oil, We see that the US has added almost 1 million barrels of the recent months, and it's still on its way to increase its oil production. And this oil production comes with associated gas. There's a lot of gas in that southern basin of Texas. And this is the main fuel for growth of production in the United States in the next years, as you can assume at a very cheap cost, because it comes for free with the production of oil, and in the very close vicinity of those LNG export terminals along the Gulf Coast. So we anticipate that the United States will take almost 40% of total production growth in the next 5 years. You also see some substantial contributions from the Middle East, China of course, with both conventional and non-conventional production increasing, Australia, Russia and Egypt as big single contributors to growth. But there's a difference in between those producers. Those who produce for their domestic markets, such as most of the Middle Eastern countries and China, and those whose production will be mainly driven by export markets. This is the case for the United States, for Australia, and for Russia, which will be the three main contributors of trade growth in the next 5 years. The two first ones, the United States and Australia, mainly, as you assume, for liquefied natural gas, so going globally. For Russia, it's a mix of pipeline gas to Europe, to China, and of liquefied natural gas also. So this is the global picture with all the increases. And you can see at the right end of that chart, Europe is sitting in the opposite position. We anticipate that Europe's production will decrease by almost 40 BCM, so that's roughly 7-8% of the total consumption of the European market in the next 5 years. What is happening in Europe? Well, first, good news, Norway's there, Norway's still there in the future. We expect that new commissioning in the Norwegian shelf will help Norway to maintain its level of production. Other sources of production are expected to stagnate, especially on the continent, but the two main other providers aside from Norway, the United Kingdom and the Netherlands, are expected to decrease substantially over the future. This owes to two factors. The first one is a pure technical factor, depletion of the resources in the North Sea. The second one is the decision by the Dutch government in the beginning of this year to phase out the production from the Groningen field, which is the main source of production of the Netherlands, on the grounds of seismic threat. So, according to the current targets of the government, the Groningen production will be phased down to 0 by 2030 and will be around 12 BCM by the end of this forecast by 2023. The Groningen production has been capped as per a governmental risk measure against seismic activity over the past 5 years, but just as some measure, at the beginning of this decade, Groningen was accounting for almost 50 BCM. So this decrease in domestic supply will lead to an increase in imports dependency for the European market. This means, all in all, new opportunities, both for traditional suppliers, such as Russia, which last year already set an all-time record in terms of exports to Europe, reaching almost 35% of market share on the European market, which was a first in history. But also for new suppliers, namely for LNG suppliers, whether it be from Africa, from the Middle East, and of course from North America. So there's some margin from increased imports, even though, as you can see on this chart, the dashed area on the top, the strong base of the long-term contracts, pipeline long-term contracts, mainly from Russia, is there to remain for a long time. There's some of those contracts eroding, especially from Algeria, and some Russian contracts to expire over the next years, but most of it is to remain on the market. So this market opening comes in the next 5 years from both a decrease of domestic production and a decrease of contracted supply from traditional pipeline exporters. So the global picture for pipeline, we estimate that there will be some growth in the future, but it will be limited mainly to Europe, to China, with a new Russian pipeline to be commissioned at the end of next year to China, and to some extent to North America, with more trade from the United States to Mexico and to Canada. But the main source of growth for trade will be liquefied natural gas. One of the key findings of this report is that liquefied natural gas will reach 500 BCM in the next 5 years, which is increasing by 25% in 5 years. It adds about 110 BCM. It's roughly the consumption of Japan as of today. So who is going to contribute to that growth? So if we look on the region per region, the Atlantic basin, so on both sides of the Atlantic, is expected to remain stable. We don't see more growth coming from Latin America or Middle East or Africa. There's a bit of growth coming from Europe to compensate for that decrease in domestic production, as I mentioned earlier. That's not a major growth for the Atlantic basin. We anticipate that Japan will remain the single biggest importer of LNG in the next few years, but its imports will slightly decrease owing to that restart of nuclear capacity. So who will consume then? China and other emerging Asian markets. Those markets are set to increase at a very steep pace, and their share is expected to reach almost 45% of LNG trade by 2023, more than doubling from what we've seen 5 years ago at around 20% of trade. This is being driven mainly by China. We expect that China will be, as soon as next year, the biggest natural gas importer in the world if you combine LNG and pipeline gas. It already last year toppled South Korea as the second biggest LNG importer. We don't see China being the biggest LNG importer in the near future, because Japan is still the biggest one. But if you add pipeline gas, China will be the first importing country as soon as next year. But China is not the only source of growth. So in that yellow bar on the chart, you have India, Bangladesh, Pakistan, Thailand, Vietnam, all those emerging markets which strive to grow and import more natural gas to serve their demands. So to have that growth, you need additional supply. This supply will be provided mainly by new projects coming from the United States, from Australia, and to a lesser extent from Russia and Africa, with the commissioning of the first Mozambique project by 2022. One interesting feature, if you look at additional capacity, liquefaction capacity being commissioned, is that there's a major shift in terms of investment. All this new capacity will come online almost simultaneously in the next 2 years, owing to a huge batch of investment which have been taken 5 years ago. So on this chart you see the increment of capacity. We're standing right in the middle of that wave. We still have 2 years to go with additional capacity coming, but after 2020 it's almost going dry. There's no new investment decision have been put forward by the industry to further fuel the LNG markets in the future. So timeliness is very important, because we see that there's a huge lump of LNG capacity coming to the market, and if we assume that these projects come on time, there might be an impact on the overall supply-demand balance for LNG. This is the green line you see over there, is the level of spare capacity, so the unused liquefaction capacity on the market. It's been quite stable over the past years, but when we have this block of new capacity coming to the market, we expect that it may take some time for the importing markets to synchronize with this capacity. So this may lead, for a little time, in an increase in spare capacity. I'm not talking about an oversupply market, because all the analysts over the past 2 years have been burnt, because we see that usually those projects don't come up online as soon as they were expected. There are some delays on the one side, and there are some unexpected surges in consumption on the other side. So there was no such thing as overcapacity in the past. But what we see in the near future is that China is already using almost all of its import capacity, and there's a strong ramping up, especially in the United States. So there could be, for a limited time, a slack capacity. But this is not going to happen for a long time, because owing to that growth, dynamic growth of the Asian markets, the spare capacity level will quickly come back to what we've seen currently. This graph is a bit misleading, because this green line only takes the technical capacity. In real life, there's a substantial amount of that capacity which is offline, for either technical or security reasons. So if we just take the capacity which is really available, the situation is a bit more dramatic in terms of spare capacity. The market's been operating over the past years with only 5% of spare capacity. And we expect that by the end of the forecast, in spite of that huge addition of liquefaction capacity, we'll go back to that 5% threshold. That means that if there's no new investment capacity commissioned in the next years, we might very well head for a tight market in the near future. And this will be a major threat to the competitiveness of natural gas and to this whole bright future picture that we've been designing in the report. So to wrap up, we see, taking from the takeaways of last year with the growth of China and all the elements that we can see in terms of economic indicators, in terms of strong policy markets from the Chinese government, we see strong growth being driven by the People's Republic of China in the next 5 years. China will be the main engine for natural gas consumption globally. On the supply side, the United States will be leading in terms of additional supply, accounting for roughly 40% of additional production and almost 75% of additional LNG supply. This is huge. I mean, this is the biggest contribution by an overwhelming share. LNG will provide the growth that is needed by those emerging markets, especially in Asia. It will grow by 30% over the next 5 years and will be the main source to achieve a more global and interconnected gas market. To make this happen, there's some challenges ahead. First, to have more interconnected market means that we need to have markets. Just don't need demand. You need to have proper markets to have this working. In Asia today, oil indexation and regulated prices still account for 80% of price making, including in very mature economies such as Japan, or Taiwan. This is a major issue for governments, especially in Asian countries, to switch from an oil-indexed or government fixed tariff market to a real market where the forces of supply and demand can make the most of the advantage of natural gas in the future. So today, even if you have access to available and competitive natural gas, in most cases you will still pay it at Brent parity level, which is a big distortion given the current market conditions. Second aspect, need a lot of infrastructure to make this happen, not only on the supply side but on the importing side. If you take the case of India, for instance, the country is lacking pipeline capacity, it's lacking regasification capacity. In the case of China, one of the big issues we've seen over the last winter is the lack of storage to meet the winter demand. China has been forced to cut several newly converted industrial customers which shifted from coal and been cut in the middle of winter because of scarcity of supply. China currently, to give you a picture, the current storage capacity in China accounts for 4% of Chinese consumption needs. In Europe, storage accounts for 20%. So there's still a long way to go if China wants to secure its natural gas supply and meet its growing needs, especially for seasonal needs. Plus, on top of all economic related and price related issues, natural gas, to prove that it's a genuine component of a sustainable energy future, has to prove that its contribution is worth it in terms of methane emissions, in terms of carbon capture, utilization and storage, and in terms of uses for the natural gas networks of innovative contributions to renewable gases such as biogas and hydrogen. Thank you very much. Muchas gracias.
Okay. Thank you very much, Jean-Baptiste, and thank you very much for coming here after being presented last week in Washington in the gas conference over there. No, well, this is the time for a Q&A session, and I would like to ask our floor if you would like to ask something to Jean-Baptiste about whatever. There's no question for him. Maybe we have a question here. You can introduce yourself for him and ask the question. Antonio, maybe not.
Thank you, Jean-Baptiste. Thank you, Arcadio, for organizing this presentation. I'm Antonio Merino. I'm the Chief Economist at Repsol, and I would like to ask you two questions mainly. The first question is about the supply response that you are projecting or forecasting, which is mainly associated gas in the US. The number that you have implies that they have enough infrastructure and enough price, I would say, incentive for oil to produce that much gas, because you have there like the equivalent to about 6 million barrels per day of oil equivalent. This is huge. I know you've been revisiting and revising the numbers upward in the midterm, in the oil midterm, but I would like to know to what extent this is the central scenario, because I tend to think that it's very high on the highest part of the market. And secondly, regarding the prices, what we are saying is demand is going to grow, not because of CO2 question, but because of air, you say blue skies. I thought that was for an airline, no? Blue skies was like a brand name, no, for a sky for air flight. My idea is that when you look at the demand, you have to look at the prices, And you mentioned it. They say they are Brent related, they are oil linked. But even if they are not oil linked, the spot contract seems to be closer to those oil linked. So to what extent, on the supply side, the centralized scenario implies that they can produce in the US as much oil in the Permian as they want, and that there is no question like, for example, different quality or different hydrocarbon concentration, infrastructure problems, and secondly, the price in Asia. To what extent, if we have those Brent prices that we are looking or having today, to what extent is feasible to have such a big increase in demand in Asia? So these two questions.
Let's try to.
Thank you.
I'm
trying. No. Trying again. No, it's not working. No. Yeah, no, still is now. Well, thank you for both. You spotted out two points which need obviously a bit more explanation. On the first one, it's true that we are, for both oil and gas, very positive for the US market. There is still a question of infrastructure investment lagging behind for both oil and gas, especially in the Permian Basin. It was the case in the Northeast, in the Appalachian Basin for natural gas delivery, and we saw it resolving over the past 2 years with lots of projects being commissioned. We also have a long list of projects from the Permian to debottleneck that capacity, both to the coast and to the Mexican border. But it is, of course, an uncertainty that we highlight in the outlook. So, as of today, the question that one of the question in the state of Texas is not how much we can export, but how much are we currently flaring of natural gas that we can't deliver to the market because of that lack of infrastructure. So we see going forward that within 2 years, most of that bottleneck issue will be solved. But assuming that the infrastructure will come online in due time. For the prices, that's also a key question, because addressing those new markets is very different from the traditional Asian buyers. India is not Japan. India is not China. They don't have the same, the consumers don't have the same price elasticity. All those markets are much more price sensitive. We've seen this with, just to give an example, one of the tenders which was issued by the Pakistani government at the beginning of the year for LNG cargoes, which was cancelled because the prices were too high. But there's no backup. So what happens is, when you don't get the cargoes, you just cut the power supply to the customers. So this is a dire situation. And it could be seen as a chicken and egg problem, because to have a price you need to have a market, to have a market you need to have a price. The problem is today that it's not a question of oil indexation, it's a question of lack of a true and reliable reference for pricing in Asia. There are some indices which have been put together by report agencies, but they are not deemed, from the industry point of view, from the exchanges I have with the industry, they're not deemed as liquid enough to reflect the importance of the market. So this is why we broadly encourage, as International Energy Agency, the initiatives such as the development of trading hubs in Asia, which will improve the situation of buyers and sellers to have a mean of confronting supply and demand and having a price which reflects this supply and demand. This is also why we push for more price reforms in the different markets, because having sufficient supply and having trading hubs is not sufficient, because if in the end the final user pays a regulated price, which is completely indifferent to the actual value of the gas molecule that you get on the market, you won't have this connection with the value of gas. And we've seen some progress. We've seen some progress in terms of price reforms in Japan, with the full deregulation achieved last year, in Singapore, in China, in India, but there's still some way to go for those countries to be able to open their markets. So this is, again, as you rightly mentioned, this is a big caveat to the forecast. We assume that emerging Asia beyond China will be a main engine of growth, provided that means are given for these countries to become accurate markets, and that gas remains a competitive solution.
Okay. Some more questions to him. Well, I will ask something more about the price, but in the Western countries, do you think that is separated, is new suppliers like a free destination, or is more split from the oil, or not? In the Western system, because you were talking about Asian countries more than
Yes.
the rest of the world.
Well, in Europe, most of the pricing is now based on gas-to-gas competition, but as you mentioned, we still have some LNG supplies, legacy contracts, which have been pegged to oil indexation. And to that, on that specific topic, the recent probe by the European Commission on Qatar's contract may come out as a trigger for more changes. But I think that the most of the supply today, even if it is oil indexed, has lost its strong destination clauses that we have in the past. So it's the premium value that you can get from those supplies being in the portfolios of those major players, being IOCs or major European utilities, is more on a day-to-day basis. Where will I get the margin? What is the premium market? Today it could be south of Europe, tomorrow it could be China, and I think that oil indexation is only one factor in that. We see more liquidity, we see more competition coming, which is positive for the end users in terms of price competition, but which can also lead to more volatility, especially when everybody needs the same cargo at the same time of year in winter.
Okay, we have another one here. It's Fernando. This is for you.
My name is Fernando Maraval. Thank you very much for your presentation. Really interesting. I would like to make just a question. If in long-term import contracts we can appreciate in some way a tendency to eliminate oil index references and to substitute them by short-term high prices, for instance, or short-term prices in general. Do you think that this can make the finance of new projects more difficult in terms, for instance, of when you think about Mozambique, or you think about the Tortue project in Senegal, or we have just recently read that Schlumberger has abandoned the project, the LNG project in Equatorial Guinea. All this is because probably traditional commercial financiers don't see very well, the short-term high pricing references in long-term import contracts. Do you agree with this? Thank you.
Well, thank you very much for your question. It's a very good point, and it's very good that you mentioned it. This is also a big concern for the industry, because those projects, especially LNG liquefaction projects, we're talking about billions of US dollars in terms of financing, so it can't be on the balance sheets of the companies. It has to be financed by project finance, which means that you need to have strong guarantees, commercial guarantees, that you will be paid back by your customers. And of course, given the current development of those alternative price benchmarks, I'm not sure, I'm not a banker, but I'm not sure that many bankers will jump at the sight of being financed on a JKM basis, for instance. I'm not certain that it is yet the norm of the industry. Although there have been some changes in terms of who takes the gas from those projects. I take aside the US projects because they're very specific. If you take the latest Russian projects from Novatek, most of the volumes have been signed with hybrid formulas. So there's oil, but there's also hub indexation in there. It's also interesting to see that you were mentioning Mozambique. The coral project output has been bought, it's in its integrality, not by a national oil company or a national importer, but by BP, a major portfolio player, without any assumed destination. So that would blend in the global portfolio of supply of BP, which will then be re-engineered to be sold to third parties with other pricing formulas. So that's also a strength to have those major go-betweens in between suppliers and end users, who can provide a natural hedge in terms of price risks in between oil indexation, gas indexation, power, coal indexation in some markets, and have a diversified portfolio which can provide that additional liquidity. So to answer, try to answer shortly to your question, I think yes, it's still a concern that those emerging market index are not up to speed to compete with the robustness of the oil indexation, but we see some patterns changing, not only in terms of pricing, but also who takes the gas and who markets the gas to the final customer. Another question here.
Hi, Juan Sanchez from Head of Market Analysis of Enagas. Thank you very much, Jean-Baptiste, for your excellent presentation. I have two questions, if I may. One is related to the last ones. You mentioned the importance of liquid markets and the important role of this portfolio place and so on in order to move ahead and supply these new markets. But I have a question on affordability. I mean, at the end you have a big chunk of the growth coming from emerging markets in Asia, beyond China and India, so Bangladesh, Pakistan, and so on. And probably these markets will not be able to pay, I don't know, maybe more than $6 or $7 per million BTU. And then on the other hand, you have most of the new LNG sources that could put this LNG in those markets maybe above these figures, 7, 8, and so on. So how do you think the industry will solve this mismatch between the affordability of these emerging markets and the cost of LNG supply? This will be one question, and the other is regarding a gas demand for power generation in Europe. So you basically said you expect a kind of a stable electricity demand and then renewables going up, and so gas is struggling to maintain its role in the market. But what about this in this period of time you are studying, so the next 5 years? What about the role of coal to gas switching? I mean, what about coal retirements and the relative prices of coal, gas, and CO2 affecting this part of the market?
Thank you very much. So going back on price, flexibility, and those very price-sensitive markets in Asia and elsewhere. Well, we tend to simplify the picture because this is a global outlook. But well, by saying that we have suppliers, portfolio players, and buyers, but of course those portfolio players, they still have a large majority of their offtakes being covered by long-term buying contracts on the other side. So for this, there's no big issue. The question is, how do you juggle with the margin that you allow in your portfolio to be sold on the spot market? And this is where the whole optimization of your portfolio comes in. Because today, if you're taking a major portfolio player, will have supply from different sources, different types of contracts, long-term, medium-term, short-term. We have different sorts of indexation, which will provide almost on real time a average value of your portfolio. So, and this is how you balance. It's not just a knot of contracts with one-way bilateral pipelines, floating pipelines like we used to have in the past. Of course, this requires some operational optimization, financial engineering. Sometimes you lose, sometimes you win. I've been in the industry and I've seen post-Fukushima and post-oil price drop. I was working with a major LNG player. We've had great years and we've had terrible years. But that's from your errors that you learn, and one of the outcomes of this big drop after 2014 was that profit was not a given in the LNG market, and that all those players had to improve their portfolio management, which is what happened. But there's still, of course, some flexibility provided by the spot markets, and those spot markets will react on supply-demand signals. So sometimes it will be much more competitive to have your old-fashioned long-term oil contract than to buy on the spot market, and vice versa. The question is, when you have spikes on the spot market and you have much more buyers from those price-sensitive countries, what will happen? Will they just pull away from the market, or will they remain? And that's the big uncertainty as of today. On the European gas demand, coal to gas switch, very, very important topic. Most of the targets for phase out are from 25 and beyond. So we are entering in between now and 23 in the gray zone. What is going to happen? Most of the switch has been done already in the UK. It's not a big concern in other countries. You take Belgium, France, Italy, there's not so much coal. In Spain, there's also the question, but it's not a dominant. If you take countries where you have, I forgot to mention the Netherlands, there's also a plan to phase out by 2030, if I'm not mistaken. The big question is, if you want to put it bluntly, is Germany. Germany has already to deal with a nuclear phase out in the next 4 years. There's no deadline yet for a potential coal phase out, although the new coalition has put the topic on the table. It's not that I don't want to answer to your question, but it's very complex. I guess that we'll have first to see how the German industry deals with replacing nuclear power. I don't see that much. I'm not a coal expert. My friend Carlos Fernandez will be much more appropriate than me to answer to you on that point. But I guess that we'll have first to see how that missing nuclear power is replaced, to see more phase out of coal in Germany. As for Poland, for other reasons, I don't believe that we will see a phase out in the next years. So those are the two main areas where you have potential for a coal phase out. I don't see that we can expect them in the next 5 years.
Okay. Last question. You have the last question, or maybe we can wrap up this question, or with last. Could the LNG, American LNG, compete against the Russian gas in Europe? This is the last.
Yes, and I was waiting for it. Thank you, Arcadio, for asking it. Well, I can answer you on different ways depending on which angle you want to have an answer. If you just add up the figures, it will be that's not a how should I put it? That's not an official view from the agency. It's just a personal point of view. But if you add up the figures, it's difficult to compete against Russian natural gas. In 2016, according to Gazprom official balance of financial statements, so not inventing any figure, the average delivery price to the German border was the equivalent of $4 per MMBTU, and at that price, Gazprom still made a margin. Most of the costs of the Russian supply chain are taxes, and for reasons that I suppose everyone here knows, this tax share could vary according to the targets of the Russian government in terms of outreach. So from a pure economic point of view, difficult. Although we have seen that countries such as Lithuania, such as Poland, such as, I'm not mentioning Germany, but there's a line in the new coalition energy pact to study the potential for LNG imports in Germany. So those countries, from a pure economic point of view, there's no need to import LNG, but they import LNG, and they import US LNG, not any source of LNG, US LNG. So economics don't make it all. Last, if you take from a geographic point of view, the story becomes a bit more complicated, because basically you take the big markets in Europe, Italy and Spain. Well, begin with Spain. Difficult to get Russian gas there. So it's difficult. If there's more LNG to come to Spain, Russia won't go there. Italy, well, they have some LNG capacity, but they're heavily oversupplied with Russian gas. But with new capacity coming from Azerbaijan in the next 2 years, I'm not sure that we can get much more US LNG coming to Italy. Moving north, the United Kingdom, also a big market, not that much Russian gas coming there. Could be Russian LNG, but Russian gas through pipelines, a bit limited. The German market, except if you have some reverse capacity from the Netherlands, not so much LNG coming. So if you eliminate those 4 big markets, which are Spain, Italy, Germany, and the United Kingdom, you remain basically with a middle market of Netherlands, Belgium, and part of France, which could be a potential battleground, if you want to use the term, in between Russia and United States for LNG supply. Taking that those countries also have their share of portfolios with long-term contracts. So all in all, we will see more LNG, and I bet that some of that LNG will be US LNG, but we don't anticipate a huge landslide from one way or the other. And last point, referring to the economics of Russian gas, it's one thing to be the best competitor in terms of cost. It's another thing to kill your market by selling at very, very low prices and giving a signal to your customer that you can sell at absolutely low prices, because they will remember that. And Russia has a very long-term strategy. So I guess that if they have to choose in between cutting one finger with lower market share for a couple of years before the Asian market pick up again and that LNG goes back to Asia, and cutting at all arms, showing that they have the muscle to sell at $2 per MMBTU, just to throw a figure, having all their main customers coming back and say, hey, see that you're making a lot of margins, we need to renegotiate those prices. I think that the deal is quite done.
Okay. Thank you very much, Jean-Baptiste. A pleasure having you here, and thank you very much for coming. Applause for him.
Thank you.